Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the TGI. Thank God it's Friday, the 5th of August, TGI Friday, Bull versus Bear webinar. Steve Miley on the call for TradeDay.com. Welcome, everyone. See, you've got some of you guys in the chat already. Morning, Tony, morning, Kaz. So we're going to go for our usual regular run through in here today, although a slight difference. I'm not going to be looking at the charts. I don't see there's a massive point because the market's going to break one way or the other, almost certainly on employment report, and I'm a little limit on time. I don't think there's a huge value. I mean, you need to set up where you see the trigger points. You can obviously take a look at my technical analysis. If you go to the trading room, which I'm not going to click through to the trading room now, but you go to the trading room, you'll see the trigger points there for the S&P. Where I think the important levels are. And for gold and oil, we're going to probably add Nasdaq in at some point, potentially early September, onto those reports. But I'm just going to do a very brief run through it. So there's really not much to say ahead of the payroll report. Stocks are saying bullish overall. We did get a slight dip yesterday. We've had a slight consolidation, a push it higher and then a dip this morning. But let's just run through some of the metrics. But I mean, it's going to be all about the employment report today. I think the employment report's growing in stature again. It's been sort of a bit on the back burner the last, I would say, 6 to 9 months, as inflation has been the real focus. Now that the Fed have fully switched on to inflation, and obviously inflation is still very much a focus, we're now looking at how much the economy globally, how much the economy in the US is starting to slow. One of the parts of the economy that is staying very strong in the US, similar to in the UK here, but certainly in the US, is the jobs market, the labour market, and it's going to be interesting to see if we get some of the froth that's still in the labour market is going to start to recede. So employment report's going to be super important today, and we've got that coming up in under 1 hour, and it's just about trading the breakout for me. Most of the time you go with the employment report. Obviously, it can be choppy because there's various elements to the report. The algos pick up certain elements, average hourly earnings. Going to be important for the inflationary pressures, but all of the report can give different signals. You get sometimes you get changes to the updates and changes to the previous data. So all of that can add in to make this a very unpredictable set of data. But generally, when the market goes, it kind of goes in that direction, at least for the next half hour to an hour. So just looking at the breakout points and whatever strategy that you guys are trading. Morning, Clinton, as well. So you've joined us as well. So yeah, it's going to be a brief. I'm just going to run through what's going on. I'm not going to go through all the charts because the levels are going to be redundant probably very quickly. Where are we? So yeah, jobs data is going to be key. We're looking for 250,000, 250,000 number in here. Going into today. Slowing in semiconductor sales, another sign of the worsening state of the global economies. That's a chip sales on a global front. In here, we've had overnight housing downturn, UK, Canada, elsewhere, getting some negative. US equities were a little change going into Friday. We're up slightly and then we're down slightly. There's been a little bit of saber rattling. I see that some China. I don't think it's actually on the. I don't see it on these news stories here, but China have announced sort of breaking off slight breaking off of not full breaking of diplomatic relations, but not talking to the US on I think environmental issues and I can't remember the other thing, military I think so. So breaking off a little bit of a dialogue between the US and China. Some saber rattling from China, the most aggressive kind of maneuvers that they're seeing off the coast of Taiwan after the Pelosi visit over the last 24 to 48 hours. So we started off with a slight risk on and drifted to a slight risk off. So there we go. Where are we then? So a fairly quiet overnight really in here. A couple of things, so Michael Burry of the Big Short fame, silliness is back in markets. I don't know why it's more silly now. He didn't really go into anything more than that. So he just, I think, tweeted this out. Yeah. I mean, he tends to do these tweets and then deletes them. The silliness is back at 929, 68 after 2000, the strain of silliness that transforms bulls into bubbles completely and utterly disappeared. But that familiar COVID era cynicism is not dead yet, like 2001 before Ian Ron, before 9FM, before Welcome. So, he thinks obviously we're in for a big down move. Markets kind of telling us a different story at the moment. Obviously, we have been in a bear market. We're seeing a strong recovery at the moment. Stocks dips, a slight dip on yesterday, slight dip on the overnights as well. European stocks in here, though, this morning you can see kind of mixed but slightly lower. French index is down 0.5%, but the German and the UK markets are fairly unchanged as we go into the day. Futures are steady ahead of monthly jobs data, so not much going on there. And European shares fall. Energy stocks weighing on European shares. So really not much to add in here, though. Sorry for coming on. I'm not going to run through all the technical calls like I usually do today. So you can see it here. If we just actually click through in here. Actually, I'm going to wind it up very shortly. So appreciate you guys coming on, though, but I don't think there's much point in running through all the technicals and the levels on this stuff. You can download the S&P levels anyhow if you want to take a look at those. We're fairly unchanged on futures in here on the overnight, having had a slight dip lower yesterday. Quick nod to the Fed tool in here. This has just crept up a little bit again. So remember, this was sitting up at the end of last week after the Fed, up in like 75 to 80 kind of area, for a 50 basis point hike at the next meeting in September. It was down at only around 25.20. But we've seen that dropped significantly. That got down to almost 50-50 after the last couple of days. As we've seen, probably unsurprisingly, some of the Fed speakers have parried back some of their predictions and trying to, there was a feeling from last week's Fed that we'd had a pivot to more dovish, and so we've had a slight shift back to slightly more hawkish. Fed speakers talking about very much on track and on course to fight inflation, and so we've certainly seen. So this dropped to like being almost close to 50-50. It's still maintained that the majority, the bigger risk of being a 50 basis point hike. This is signaling this column here as a 50 basis point hike, the first column. And but it got down to like 55.45 early this week after those Fed speakers. It's starting to climb back up higher again in here. So again, the kind of maybe that dovish tone coming back into the markets. And that's kind of helped stocks in here over the last few sessions, although we did get a dip yesterday. Markets have had very bullish moves, though. So, I think today, I'm going to run through all the levels in here, guys, on the technicals. I really don't see, you pick your own points in here, really. I mean, pretty much the recent highs in here on the S&P and NASDAQ are going to be important levels. You pick your own levels on the downside. I think it's a matter of trading the breakout and just going with those breakouts post-Fed. Usually, as I say, it's not post-Fed, post-payroll. Usually the employment numbers, the market does go that way for the initial move. Now, often it does reverse in the session as well, though. I think it's just as much chance as it reverses within the session as it continues. Okay, so but the initial move usually continues going into the cash market open. So between in my time it's 1:30 through 2:30. Your time is probably going to be something like 7:30 or 8:30, right? Depending whether you're Central or Eastern. We have some guys on the Pacific time as well, but depending where you are on the in the US, or if you could be in UK or Europe. So, but basically for when the data comes out, which is in about 50 minutes. For the next hour up to the cash market open, the market tends to just go in the direction, right? It's usually maybe 30 minutes and then continues through the cash market open. And then what you tend to find is sometimes it reverses about 30 minutes to an hour after the cash market. Sometimes it just continues. So, but usually that first move lasts for about 60 to 90 minutes through the cash market open. So, and as I say, I'm not going to run through today on all the levels because I think, one, you guys can pick your own levels. And two, those levels are going to be very quickly redundant as we break, and you can pick up the levels off the reports anyhow. So I'm going to wind it up there. Apologies for a slightly brief webinar in here today, but I think the one before the payroll, the markets are usually quiet. They're usually in consolidation, and that's what we're seeing. They're in a holding phase, and then obviously we get the explosion. So helmets and goggles. Have a great trading day, everyone. Have a great weekend too. and I'll be back with you to pick the bones out the employment report and see how we're looking going into Monday. Have a great day, guys, and yeah, good weekend too. Take care.